Disney stock has been a terrible investment over the past decade with no gains during that time. In fact, the stock is down 38% over the past 5 years. And even today, after beating earnings expectations and reporting their first quarter ever of streaming profitability, the stock is down another 4%. So what happened? Today I'm going to analyze why Disney stock has been falling and provide an updated stock analysis on the company following their Q3 earnings report. And I'll answer the questions. Is Disney stock now a deep value buy? Or should you stay away? If you stick around to the end of the video, I'll provide price targets and future earnings estimates. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Please sign up for our email newsletter so you can get these videos plus a bunch of other great content straight to your inbox. Also become a member of dividenddata.com, which is the stock research tool I'll be using throughout the video. Links in the description and pinned comment. So Disney is my worst investment ever. I bought most of it during 2020 and 2021, and I'm down 37% overall. However, I've continued holding it as I view the stock may have good returns from here. But this was definitely a mistake and my worst buy ever. So I'll start doing a little recap of what I got wrong about Disney stock and why it has tanked since I bought. First off, the main profit driver in all of traditional media, including Disney for decades, has been the cable TV bundle. This is a declining business segment as the number of cable TV subscribers continues to decline year after year. And that is a massive problem that has been plaguing the entire traditional media industry. We'll talk more about that later. But the entire landscape is shifting away from linear television towards streaming services. Netflix led the charge there, and they have now reached a scale where they have an incredible, highly profitable business in streaming. So the question is, which media companies, if any, will be able to replicate Netflix's success in streaming? And this shift in streaming is going from a highly profitable but declining business in cable TV to a high growth business that was unprofitable for many, many years. So this took a big hit to Disney earnings. And if it couldn't get worse, there was a global pandemic that shut down movie theaters and shut down all of Disney parks for a year. This caused Disney's business to decline significantly and add more debt to their balance sheet. However, the parks business has now returned to all-time highs in profitability, but they still had the major problem of streaming losses in 2022. They followed a growth at all cost strategy and had a gigantic quantity of content they were pushing out of all their studios. And they were able to gain over 100 million subscribers, but the profitability was not there. Their combined streaming business, which includes Disney Plus, Hulu, and ESPN Plus, it peaked in Q4 2022 at negative $1.5 billion in losses that quarter. That's in one quarter. That's how much money these streaming services were losing. And the massive quantity in content also brought down quality significantly as they had less focus on each individual title. So this led to worse performance in the box office for movies and lower quality content bringing down the Disney brand. And it's at that point that longtime Disney CEO Bob Iger returned to the company to turn it around. And in just under 2 years, the business is improving significantly. Direct-to-consumer streaming losses have gone from negative $1.5 billion to a profit in the latest quarter reported. This is a gigantic change that has helped their bottom line significantly. On top of that, the quality of output is starting to improve. Inside Out 2 is just released, breaking $1.5 billion worldwide at the box office. Deadpool and Wolverine just came out, which will cross $1 billion in the box office. And while it's important to note that no individual movie title really has that big of an impact to Disney's business, it helps fuel the entire flywheel of their company. For example, since the trailer for Inside Out 2 was released, over 100 million people have viewed Inside Out 1 on Disney+. And just the old movie has driven 1.3 million Disney Plus signups. And this is not even to mention the impact that will happen once that movie goes on to the streaming service. Another boost then. So every massive blockbuster success just adds to the flywheel around the company. And this gets expanded even more when you consider consumer products and the Disney theme parks and all of these different things. So despite the stock price being near recent lows, the actual business is improving significantly since 2020. It has posted $1.39 earnings per share for the latest quarter, and the company is now consistently generating high and growing profits. And this is demonstrated by them bringing back the semi-annual dividend payment, and they've even started share repurchases as well. So let's take a look at the Q3 earnings report. Revenues for the quarter increased to $23.2 billion, which is up from $22.3 in the year prior. Diluted earnings per share is up to $1.39, up from $1.03 in the prior year quarter. Total operating income is up 19% year over year, and adjusted EPS is up 35% year over year. And the operating income in the entertainment segment, which includes their streaming, has nearly tripled year over year. The only negative in this earnings report is that they have seen a slight demand moderation in their domestic parks business. And we'll touch on that in a little bit. So here you can see that entertainment revenues increased 4% year over year, sports revenues increased 5% year over year, and experiences revenue grew 2% year over year. And the way to think about this basically is entertainment cable TV channels plus Disney Plus and Hulu, sports meaning ESPN plus ESPN Plus, and experiences meaning their Disney World, Disneyland, and their international parks and consumer products they sell. Operating income for entertainment nearly tripled year over year. Sports operating income declined 6% year over year, and experiences operating income declined 3% year over year. And with this experiences operating income, you have to consider that 2022 and 2023 were both very great years at the company. So it's being compared to a strong base, and this is still $2.2 billion in profits for that quarter. Now, of course, long term, we do want to see 5, 10, 15% growth year over year. And if we look at the prior 9 months, experiences operating income grew 6% year over year. So they're still seeing long-term growth. And if we look at their entertainment business, the linear networks are the main profit contributor at this time, but they're slowly declining year over year. For example, linear networks operating income was down 6% year over year from $1.02 billion to $966 million. However, the big difference here came when direct-to-consumer had a $505 million loss down to $19 million in losses. And if you include ESPN Plus, which I'll get to later, they actually turned a profit for the first time as a combined streaming business. So the real question with Disney's entertainment business is when direct-to-consumer profitability surpasses that of linear networks. And I think it's around that time that the narrative around Disney stock will completely shift. And this will happen as they continue to bundle services together, raise prices, and reduce churn, on top of increasing subscriber growth. Direct-to-consumer revenue increased 15% year over year, and revenue for direct-to-consumer is already over double that of linear networks. And if you just look at Netflix as a comparison, there is already wide evidence that you can be highly profitable as a streaming-first business. And if we look here at the combined direct-to-consumer streaming business, you can see that they posted a $47 million profit in Q3, which is one quarter ahead of the guidance they had given previously. And when we look at the streaming business, they're just going to continually march their way to high profitability. And we're on a path where in 5 years, they could be doing $1 billion profit a quarter from their streaming business and growing from that base. So with the sports business, ESPN is the cash cow here, and they actually increased 5% year over year, with operating income up 4% year over year. However, the decline came from increased losses of 45% in Star India. But ESPN is still a reliable cash cow and actually slightly growing despite the cable TV bundle decline. And the experiences business is fantastic and unmatched by most of their peers in media. Revenue up 2% year over year. And the only reason there was a slight decline in operating income was because of a 6% year over year dip in domestic parks. And this is actually the only reason why the stock would be down after this earnings report. And it is the question most analysts were asking Disney CFO Hugh Johnston in his latest interviews today. Hugh Johnston, by the way, was the longtime CFO at PepsiCo, which is a high growth dividend aristocrat. And I definitely like the hire, and he's bringing a lot more financial stability to Disney, along with Bob Iger, so they're objectively just improving the business significantly. And here they ask him a question about the slowdown in domestic parks.
One of those areas we're starting to see a little early focus on, Hugh, is it's the experiences or the parks business. Sales up, operating profits down, but what you noted about moderation of consumer demand at the end of the quarter, towards the end of the quarter, I guess that last month, Hugh, what exactly did Disney see?
Yeah, Brian, great to be with you guys, and good morning. In terms of the parks business, I do think people need to focus on the fact that the business grew in the quarter, and the business is a little bit different construction than it was in the past. Right now, 40% of the business is not domestic parks. It's either consumer products or international parks. Now, within that remaining 60% that's domestic parks, we had attendance flat, and we actually saw per caps up a little bit. So in a growing business, we have a little bit of inflation, and as a result, the OI was down. And with that weakening, I think what we're saying is, hey, probably going to see another few quarters of that, and then we expect the business to bounce back to closer to where it was. So The more important point here, I think, though, is the portfolio for Disney is working really, really well. Obviously, the numbers were great. 4% revenue, 35% EPS growth, 30% guide. But the entertainment business profitability tripled. And we've been talking a lot about, the creative engine really getting back on track. And that's what we've also seen over the course of the last 3 months. We've had the 3 biggest movies in May, June, and July. And as a result of that great performance, obviously the entertainment numbers are terrific. And that's really the heartbeat of the company. That's the one that pumps oxygen into the rest of the company. So we feel good about that. And obviously the streaming service, we did what we said we were going to do, and we did it a quarter early. So we feel good about that as well.
So I have no doubt that the parks business will remain a strong profit generator. It may have a couple quarters of flat to slight decline in growth. But if you're investing in Disney, your main focus has to be on turning that streaming business into a profitable growth engine for the company. And a big part of that is releasing higher quality content, and likely less of it, while keeping your costs constrained. And Hugh is about to bring up a fantastic point that if they can execute on, which I'm already starting to see the signs of, then that will be massive for the company.
But a lot of investors forgot, I think, how powerful those creative engines at Disney could be when they're all aligned and rowing in the same direction.
Yeah, it's a great question, Brian. One of the things that our CEO, Bob Iger, and the team have been really focused on is really taking us back to the days of excellence when we were producing multiple billion-dollar movies every year coming out of the studios. And the focus has been on not being satisfied until we achieve that standard of excellence that really is what Disney is all about. And if something isn't ready, we'll delay it by a couple of quarters. If a project looks like it's not going well, we'll actually cancel a project.
This is so important that you have to pause. It's such a major shift at the company. If something is not up to quality, they will delay it until it is, or cancel the project outright. There is brand damage associated with putting out subpar content, and it actually ends up hurting future releases if you continue to put out garbage.
And as a result of that, the products that you see coming out in the form of terrific feature films are truly, truly excellent. And that has been a notable change, and one that we've been talking about, but now you're seeing the evidence of it. And my expectation is, as we move forward to Mufasa and as we move forward to Moana 2, you're actually going to see more and more of that positivity showing up in the results. I don't view these as one-offs. I view these as the start of a significant trend. You see the same thing happening in the TV studios with obviously all the Emmy nominations that we've received with The Bear and Shogun and Abbott Elementary and Only Murders in the Building. A real focus on excellence out of the creative group, which is sort of the heartbeat of the company and really sort of drives the rest of the company, is, I think, what we should be expecting going forward.
Is it fair to say, Hugh, that Disney is just back to making higher quality content within the movie business? And it's okay if you don't churn out a large volume of titles just to satisfy a number on a budget line.
I think that's exactly right. I think to some degree when we got into streaming, we got a little too aggressive on quantity, and it's difficult to expand capacity that quickly. And to some degree, perhaps the quality suffered a bit. In today's world, particularly trying to get people to go to movie theaters, you need to deliver a super high quality product. And as Bob came back, that was one of the things he immediately diagnosed and focused the team on. And as a result, you see that happening right now. Now, it takes a while to do that, and we've been talking about it for a few quarters, but now you're seeing it in action. And I do believe you're going to see super high quality product coming out of our studios. The creatives are doing a great job.
This point is so important. They were increasing volume so much, trying to fuel their streaming services, that quality dropped significantly. So each title, it had far less impact and reception and had downstream effects of hurting other title releases as well. Plus, they were losing money from doing that at massive scale. So it was a lose-lose situation. And now they have shifted their strategy back to less volume, increased focus on trying to make each one better. So not only does that lower costs, but it's increased operating results as well. And it's clear to me that Disney is on a path where in 2 years they will be hitting all-time record highs in earnings and a base to grow from there. And this is while the stock price is massively depressed. So I actually think that Disney stock is a good value play at the moment. And if you are to buy the stock, now is a far better time than any time in the past decade. The consensus price target among Wall Street analysts for Disney stock is $140.47. That means the company is 63% undervalued at this time. That's a 63% upside. In fact, it's currently trading below the Wall Street low price target of $93. The consensus rating is a buy, with 89% of analysts saying buy, 2 saying hold, and 1 saying sell. And the reason for this is the significant improvement in Disney's earnings. After the end of fiscal 2024, they are projected their non-GAAP earnings per share will be $4.77 for the year, and that would put the company at an 18 PE ratio. However, these improvements are just still starting. And then from that base, they're projecting 2.8% growth in 2025, 16% growth in 2026, 21% growth in 2027, and 7% growth in 2028. So at the current stock price, you'd be paying an 11.5 P ratio for those 2028 earnings. And this is an extremely reasonable earnings estimate, in my opinion. I actually think it could be larger. And if this happens, which I think is extremely likely, then the entire narrative around the company is going to shift. You'll have a streaming growth business, which will be their #1 revenue generator, consistent earnings growth, high free cash flow, a growing dividend payment, which will continue to increase over that time, and share repurchases will come back as well. And this is the reality that's going to happen with Disney stock. The question is how long it takes the market to react to it and realize. I'm holding on to my Disney stock position even though I bought it at a terrible price, and I've actually continued to slowly add to it while it's at these lows. If you found this video to be valuable, then please leave a like and subscribe to the channel. Sign up for our email newsletter so you can get these videos plus a bunch of bonus content straight to your inbox, and sign up for dividenddata.com to use my stock research tool. I've built it to help you find better stocks, and it more than pays for itself. Link in the description and pinned comment. Thanks for watching.